Hi everyone, I'm James Harte and welcome to this Orbex Trader Education session where we're going to be talking about price patterns and price action trading. So during the course of this session, I'll be discussing what price patterns are and how they can be useful to you in both analyzing the market and actually forming trading ideas, as well as walking you through some specific price patterns that you can use in your trading. So as ever, if you have any questions during the session, please just write them in the chat box and then I'll stop as we go along to answer them. And we can also have a little bit of time at the end for any Q&A. So as always, let's jump straight in. And first of all, we're asking, what are price patterns? Well, the key to understanding price patterns is to first of all understand what price action is. So when we're talking about price action, we're talking about studying the historical and current movement of price to gain an understanding of how the instrument is behaving, and we're seeking to identify patterns and sequences that tend to yield specific results with a view to capitalizing on these in the future. Now, you might have heard the term price action thrown around quite a lot, and for new traders it can be a little confusing, I guess, because different people mean different things when they use the term price action. But generally, price action is simply referring to the study of charts without the use of a technical indicator. So that's it, whether we're talking about trend lines and channels, as we have done in previous sessions, or support and resistance, chart patterns, candlesticks, etc. It's all just price action. So whenever you're looking at a naked chart without a technical indicator, that is simply price action. Now, for some traders, I know that without the use of several different indicators giving different information and signals, it can seem a little daunting to look at the charts and try and decipher what's going on. And once you start to look at price action trading and the various chart patterns and candlestick formations, I guess that it can still seem pretty daunting. Now, price action is actually at the core of my own trading, and I've gone through the process of learning what works for me. And so in this session, instead of just giving you a brief overview of a whole host of different patterns, we're going to focus on just a few patterns and price action setups that can work really well in your trading. And as ever, we're going to keep things simple and straightforward in these sessions, with the hope then that these will lead you to further research and study of your own to build your understanding of these patterns and choose which patterns indeed you want to use in your own trading. So let's kick off first of all then by looking at our first structure, which is the falling wedge. Let me just move something out of the way for a second. Okay, so our first structure then, the falling wedge, and here you can see in this beautifully drawn diagram. So the falling wedge is a classic chart pattern, and it's one of the most popular patterns among price action traders because it can often lead to powerful breakouts. Now, the falling wedge is a bullish pattern, and it's formed by these two converging trend lines. So for anyone who's unclear, these two outer trend lines, which are giving us a sort of cone shape, they're the actual trend lines, and then this zigzag movement is supposed to represent price. So apologies if that wasn't totally clear. Okay, so as I say, the pattern is formed by these two converging trend lines, and the trend lines show a narrowing range. And you'll also notice that the upper trend line has a steeper gradient than the lower trend line. So the lower trend line is actually coming in at a flatter gradient. And the reason for this is that it's showing that buyers are stepping in earlier and earlier on each decline. So each time price sells off, you can see that the decline is getting shorter and shorter each time because buyers are stepping in earlier and earlier at each point. Sellers are failing to drive price meaningfully lower, and this is the whole premise of the pattern, okay? It's essentially alerting us to the fact that there's a potential shift in momentum in the market, a shift in sentiment. So sellers are still in control, pushing the market lower, but each time there's a sell-off, the decline is shorter and shorter, and buyers are stepping in earlier and earlier each time. Okay, so in the same way that we can use indicators to get information on price movement, you can see that we can actually gain really useful and actionable information just from studying the movement of price with our eyes. So again, to reiterate, in this scenario, the contracting range shows that momentum is waning, and then the flatter gradient of the supporting trend line shows that buyers are stepping in earlier and earlier each time as sellers fail to drive price lower. So in terms of how we're looking to trade this then, essentially what we're looking for is a bullish breakout. Okay, so we're looking for price to continue to oscillate within that contracting range, and then eventually we're looking for price to break out above the resistance trend line, signaling the breakout higher. Now, when it comes down to how we actually enter the pattern, we have two options really. So the first of all is what I call an aggressive approach. And this is where we simply look to enter as price breaks out above that trend line. So if you can imagine now that this is a candlestick chart, which we'll move on to in a minute. But for now, if you can imagine that this is a candlestick chart, and as price is breaking out above that trend line, we have the option of entering mid-candle. So let's say this is a daily chart and we're in the middle of the day, price has broken out above that resistance trend line, we could go ahead and enter in on that candle. However, I don't particularly like this approach because it often leads to getting whipsawed on false breakouts. Okay, and I'm sure for any of you who have tried your hand at price pattern trading, you've experienced this a lot. I know that I certainly did and still do odd times now. So essentially what happens is price breaks out above the resistance trend line, traders get in long, but they get in long prematurely, and then over the course of the day price simply reverses, closes back inside the structure, and then sometimes can go on to see a deeper reversal. So the way that we protect ourselves against this, or protect ourselves as much as possible, is to wait for a candle close. So our second option when it comes to how we enter this trade is waiting for price action confirmation. And so again, going back to our example, if this is a daily chart that we're looking at, we would want to see a daily candle close outside of that resistance trend line. So at the point that a daily candle closes up at this point here, for example, let's say we get a nice big green bullish candle that closes outside of the resistance trend line, this acts as further confirmation of the breakout, because on that session bulls have remained in control enough to keep price above that trend line, and so then we go ahead and enter on the break of that candle. Now it doesn't mean that we won't still suffer some false breakouts. Of course this will always happen. No trading system or methodology or setup is 100% foolproof, but waiting for that extra confirmation for the most part will protect you against more false breakouts. So once we've entered the pattern then, our basic target is simply for a retest of the top of the structure. Okay. Now, while this is indeed a bullish pattern and we're looking for a breakout, what you will often find is that price retests the top of the falling wedge structure only to then reverse, and this can often catch a lot of traders off guard. So depending on how you trade, you should really either look to exit the trade there as price tests the top of the structure, or at the very least move your stop up to break even, because you will find a lot of the time that price will test the top of the structure and then simply collapse lower. Because what you have to remember is this pattern tends to form in bearish trends. Okay, so price will be in a bearish trend, we get this waning of momentum, we get a reversal higher. However, this doesn't always mean that the trend is reversing in full. What it can sometimes be is an instance of short covering, where some bearish traders are covering their positions and that leads to a pop, and it can simply be a correction higher. It doesn't mean that the trend is going to completely reverse. So for the sake of trying to maintain positive risk reward and gain these 2 or 3 to 1 trades, what I always suggest is that when you trade a falling wedge, you really look to either bank at the top of the structure or move your stop to break even if you are holding, anticipating that you get a deeper correction higher. Now, another key point that we have to bear in mind with this trade in terms of how we enter it is the actual size of the structure itself. Okay, so if we look at our entry as being around this point here and our target being here, I always advocate looking for at least a 2 or 3 to 1 return. So that means that we should only be looking to enter in the bottom third, or the bottom quarter really, of the bottom third rather to bottom half of the pattern. Now, if we get a large bullish candle that comes up here, then what we actually do is negate our positive risk reward, because if we're entering in the middle of the structure, then we're only really going to get a one-to-one return, okay? So what we're always looking to do is we're looking to find a breakout that gives us an entry in that bottom third or bottom quarter of the pattern, where we can get a nice 2 or 3 to 1 return as price tests the top of the structure. What we don't want to do is enter if price breaks all the way up. And this does sometimes happen. You do sometimes get these large bullish candles which will pop right up into the middle of the range, often on an aggressive news release. However, if you enter on these candles, you expose yourself to too much risk, because our stop placement on these patterns always needs to be below the low of the structure, okay? So we're looking for a breakout above the resistance trend line, we get long at the candle close, and then our stop goes below the last low of the structure. So what we always need to do is bear in mind the actual size of the structure and the amount of potential profit that's on the table. And if price closes too far up into the range, then we simply have to let it go, okay? There will always be more patterns to take, and what you always want to be doing is thinking about protecting your risk and giving yourself as big a chance of getting a reward as possible. So if the bar closes too far into the range, you just have to let that one sail by. Okay, so let's take a look now at the pattern on the price charts, and here you can see we have a great example of the pattern that we've just looked at. So we have our two converging trend lines here showing that narrowing range. You can see that price has been moving in this bearish trend, selling off for several months. Oh, sorry, I've skipped ahead there. Okay, so price has been selling off for several months, and then at the bottom of the chart here you can see that this selling pressure has just started to abate slightly, and you can see that flatter gradient of the supporting trend line showing that each time price sells off, buyers are stepping in earlier and earlier, and then at this point here you can see what happens. Price pops up out of the resistance trend line and we trade higher, and in this instance you can see that we actually made it back above the top of the structure. However, then shortly after that, you can see that price reversed and started to trade low again. So this is a great example of, as I say, a really fantastic structure that you can look to trade. Now, I mentioned that price action trading is simply trading the charts without indicators. However, it is totally possible to analyze the charts on a price action basis and then look to add in technical indicators as confirmation for execution. Okay, so another way of assessing the market using this pattern is to combine its actual technical structure with a momentum indicator such as RSI. So we're looking for a reversal higher, okay? So if we're looking at the RSI indicator, we want the RSI indicator to help us spot a potential reversal. And one of the great things that we can use the RSI indicator for is to highlight divergence. So if we look at that same pattern again, but this time with the RSI indicator on, now for those of you who aren't aware, the RSI indicator measures momentum in the market. So when the RSI indicator is along this bottom line, it shows that momentum is oversold and there's a potential reversal higher. And when the RSI indicator is along its upper threshold, it indicates that momentum is overbought and there's a potential of a reversal lower. Now, we can also use the indicator to highlight divergence. So what you can actually see that's really interesting with this pattern is, as price is pushing lower, so we're still making new lows, you can see that the indicator is starting to trend higher, putting in higher lows. So this basically confirms what the pattern suggests to us. The pattern suggests that bearish momentum is failing and that buyers are starting to step in earlier and earlier. And the RSI indicator is confirming that, because the RSI indicator is no longer putting in new lows, showing that there's still strong bearish pressure. The RSI indicator is now starting to move higher, alerting us to the fact that there is a potential shift in the underlying momentum. So we can go ahead and draw in our pattern and use that to identify a setup, and then we can go ahead and use our RSI indicator to confirm that pattern. So for those of you who like to trade with technical indicators, this is a fantastic way of getting some extra confirmation on this trade idea by using the RSI indicator to confirm the potential for a reversal. Okay, so let's quickly move on then and take a look at the bearish version of this pattern, which is the rising wedge. So you can see here that the rising wedge formation is simply the inverse of the falling wedge. So this time we're looking at a bearish reversal pattern, and you can see that the range is still contracting, but this time it's moving to the top side, and in this scenario it's the upper trend line that has the flatter gradient. And this is showing us that, as we saw, the opposite of what we saw with the falling wedge, this time buyers are starting to lose control and sellers are stepping in earlier and earlier each time. So each time price goes up, sellers are stepping in earlier and earlier, and again this alerts us to potential for a reversal. And exactly the same as we saw with the falling wedge, all we're looking to do is trade a breakout. So this is a bearish reversal pattern, meaning that we're looking to get short. So we want to trade as price breaks down below the low of that rising trend line, a stop goes above the recent high, and then we're simply looking for a target at the bottom of the structure. Okay, so that's how we trade wedges, and again, these are a fantastic structure to trade, and like I said, they typically precede big moves in the market because what they're showing us is a contraction in momentum and a contraction in volatility, and then what we typically tend to get is a very volatile shift in order flow and a breakout, a clearing of the order books. And this structure essentially highlights compression in the market and then the subsequent return of volatility, and they can present very profitable opportunities. So these are definitely a pattern that you want to look to learn to trade and then to watch the markets for. Okay, so moving on then, the next structure that we're going to look at is the flag pattern. And again, this is another classic structure that's been used by trend traders specifically for many years. Now, where the wedging pattern is a reversal pattern and usually occurs during the end of a trend, the flag pattern is a continuation pattern that occurs during the trend and offers traders the opportunity to enter the market as the trend resumes. So here we go. So here we can see our flag pattern. Now it's called the flag because the idea is that the trending move preceding the flag represents a flagpole. So imagine our straight line here is the flagpole, and then this little channel that we get is the flag. Okay, so what we have here is an initial bearish swing. We've got price moving in a clear bearish trend, making lower lows and lower highs. And then at this point here, you can see that we start to get a correction higher, and we build this small bullish channel. And then at this point here, we get a breakdown through the rising channel low, so through our flag low, and then price sells off. Now the great thing about this pattern is that it's really easy to spot, okay, because of the contrast between the different periods of price action. So you can see that we get a large expansion move with our trend, and then the flag itself will be this choppy, blocky sort of range type scenario. So you can see that where we've got a relatively straight move and then a relatively sideways move. So you should be able to spot these patterns fairly easy once you've finished with this session. And as I say, the great thing about this pattern is that it helps us to enter into trending markets. So we always want to be looking to trade on the side of the trend for as much as possible so the momentum is in our favor. And this is a really fantastic pattern for helping us do this. Now, in terms of how we trade the pattern, the simplest way is to enter again on the candle close as price breaks down through the flag low, and then we put our stop above the recent high. Now, in terms of targets, there are really two options. So as a minimum, like I say, I always advocate aiming for a 2 or 3 to 1 return. However, understanding that this is a trending market scenario, this is typically a pattern that occurs in trending markets. For traders that are more comfortable holding for longer term moves and for bigger targets, you can simply look to trail your stop down as the market expands. So you can see here that price broke down and traded off fairly solidly down to this point before we got a reversal. So again, another really simple, straightforward pattern that you can use that can give you really powerful entry points to the market. Now again, as with the wedging pattern, there is a counter pattern. So this is the bearish version of the pattern. And then we also have the bullish flag, okay? So you can see here again, the exact same principles apply to the pattern, except this time we're trading in the opposite direction. So you can see that we've got a bullish market with price trending higher, putting in higher highs and higher lows, before at this point here we start to get this correction lower. And you can see actually that we also had a flag pattern form here. So you can see that we started to get this choppy correction to the downside before an explosive move higher, another choppy move to the downside where we're able to put these channel lines in, and the channel lines are what highlight the flag formation to us. And then simply all we're looking to do is enter as price breaks out above the bearish trend line of the flag with a long order, and then our stop is going below the low. Okay, so with a bearish flag we're entering short as price breaks through the flag bottom with our stop above the flag top, and then with a bullish flag pattern we're simply looking to enter long as price breaks out above the flag with our stop below the low of the flag. And again, you can either look to target a 2 to 3 times risk return, or you can look to hold a little longer. But remember to always be trailing your stops up to break even, and always looking to trail your stops up to bank profit. So let's move on then and take a look at another pattern. And this is one of my personal favorite patterns, and it's a very classic, very famous pattern, and this is the double top pattern. So what this pattern essentially shows is a rejection, a strong rejection at a price level, and then it highlights the likelihood of a reversal. So the basic structure of this pattern, and you can see why they call it a double top, is because we simply have 2 swing highs which occur at the same level, and they give us this M shape. You can see we've got the letter M forming with these 2 double tops, and you'll sometimes hear double tops being referred to as M tops. And essentially what is happening at this pattern, if we talk through the underlying order flows, that bulls are initially in control, driving price higher. The price trades all the way up to the first top where we get a strong rejection and price sells off. This gives us our reaction low. Buyers then step back into the market and drive price back up. We trade right back up to test that initial high point. However, buyers are unable to take price above that level, and sellers once again step in and drive price sharply lower. So price reverses from that level and then sells off. So this is what this whole pattern is about. It's about a strong rejection at a specific price level. So this is a brilliant example of a double top, and the way in which we look to trade this pattern, again, there are 2 options really. So the first is the aggressive option. So the aggressive option is where we anticipate the formation of a double top. So we highlight our first top, we see the reaction low, and then as price is trading back up to that level, we anticipate that this could be a double top pattern. However, we don't just go ahead and sell at the level, because that would be foolish. What we wait for is some price action confirmation. So you can see here, if we look at the candlesticks that formed as price tested that double top, you can see that we got a strong rejection initially. Okay, so if we look at this bullish candle, price traded all the way up to this point. We actually breached above the top of the double top before sellers stepped in and drove price sharply lower to close at this point. So when I see a candle like this at a double top formation, if I'm looking to take an aggressive trade, I would be comfortable going ahead and entering a sell order as price breaks down below the low of that rejection candle. So that's our first method for entering the trade. And again, what we're always looking to do with these double tops is enter a sell order, put our stop above the high of the double top, and then we're looking for a minimum of a 2 or 3 to 1 return. Now, another way in which we can trade this pattern is to wait to sell the reaction low. Okay, so if we think about what the pattern is showing us, we've got buyers in control, sellers in control, buyers in control, sellers in control. So this area here, the reaction low, this is the key pivot point to this pattern. Okay, this is the battle line, if you will. So this is the point at which we need to either see buyers step back in and drive price higher, and then we know, okay, this isn't a double top pattern, price is going back up, or we need to see sellers take that level out, and if they do, we can then say, okay, this is a double top, sellers are now in control, they've taken out this level, and as price breaks down through that reaction low, we can go ahead and get short. So this is another way in which we can look to trade this pattern, and if we are trading in this method, again, what we want to be doing is putting our stop above the top of the pattern and then targeting a 2 to 3 to 1 return on that pattern. Now, another way that we can look to trade this pattern, as we talked about earlier with the wedge pattern, is looking to use an indicator to help us confirm the trade idea. So if we're anticipating that the bullish trend is going to reverse from this level, then once again we can look to momentum indicators for signs of a potential reversal. So if we look at the same example again, but this time with the RSI indicator turned on, you can see that this time around we have classic bearish divergence. So price has traded all the way up to this initial high, and you can see that we put in an extreme high here. Sellers then stepped in and drove price down to this level, and you can see that the RSI indicator came off a bit, showing that bullish momentum had receded. However, look what happened at this point here. As price traded back up to retest the double top, or to form the double top rather, notice what's happening with the RSI indicator. The RSI indicator hasn't moved up to a similar level. It hasn't indeed moved higher. Now think about this. If this was a confirmed bullish trend and price was going to continue higher, then as we've seen at these three peaks, okay, as price pushes up to these three high points and the indicator continues to put in new highs, we would want to see a further high point put in on the indicator to confirm to us that bullish momentum is still strong and that price is likely to break higher. However, the indicator fails to put in a new high. And so at the point that price makes that double top, you can see that the indicator has put in a lower high, and this suggests to us that bulls have lost control and that there is a strong likelihood of a reversal lower. And so in the same way that we use the wedge pattern in conjunction with the RSI indicator, we can do exactly the same thing with the double top. So where we see these two highs forming and where we identify this bearish divergence, we know that momentum has failed. We know that we have a potential classic reversal pattern here. And so again, we can either look to enter on a reversal candlestick at the level, or we can look to enter as price breaks down below the reaction low. And once again, our targets are still exactly the same. So however we enter, whether it's with a candlestick confirmation, whether it's selling the reaction low, we're always looking to target a minimum of 2 to 3 risk reward. And you'll notice that I mentioned this idea of 2 to 3 times risk quite a lot in these sessions. And it's because it really is such an important idea for you to grasp and to use in your trading. Because a lot of new traders get caught up trying to achieve really high win rates. Okay, so they think that to be successful in trading, you need to have a 70 or 80% win rate. Okay, you need to be winning nearly all of your trades to be successful. However, the majority of successful traders actually have much lower win rates than this, but what they do have is strong risk reward. So you have a lot of traders hitting 40 to 50% win rates, but they have 2 and 3 times risk reward trades. So that means on each trade that they win, they're winning at least 2 to 3 times the amount that they lose on their losing trades. And so in the long run, if you can maintain a positive risk reward of 2 or 3 to 1, you'll find that you have a far easier time achieving profitability and also maintaining profitability. Okay then, so the last pattern that we're going to look at is simply the inverse of the double top, and that is of course the double bottom. I hope that you guessed that. So this time around the pattern is a bullish pattern, and we're looking to use it to find buying entries to the market. So you can see here that we have simply the exact opposite of the double top. This time around the dynamic is simply that we identify sellers in control pushing price down into a low point where buyers step in and drive price higher. So this time we get our reaction high, and then sellers step in a further time to drive price back down. They take price all the way back down into a test of that initial low. However, sellers are unable to push price down below that level, and buyers step in to drive price strongly higher. And so you can see that this time around we have a W shape, and what you'll often hear these patterns referred to as is a W bottom. Now, one thing to point out here is that you'll notice that I've drawn 2 lines at the support level, okay, and I just wanted to highlight this because this is a really important point. So the first line that I've drawn, which is the bottom line, is the very low of this candle, okay, and then the second line is the closing low. Actually, that should be a little bit higher, sorry, I looking at that as if it was a bearish candle. So that line should actually be up here, because what you want to do with these support areas and resistance areas is look to highlight zones instead of specific levels. Okay, so instead of simply putting a line in which is the very low of this bottom, you want to identify a zone, because the gap between the very low of the candle and the close of the candle is where the change in order flow occurred. So that's the active area in which order flow changed. And so as price comes back down to retest that area, the reversal can occur anywhere within that area. So what you really want to do is focus on highlighting these zones instead of a specific line. And the way that I do that, the easiest way to do that, as I say, is simply drawing a line at the low and at the close. And if it's a double top, draw a line at the high of the candle and then again at the close. And this will give you a zone that you can monitor for these reversals. So this is a bullish pattern, as I say, and again all we're looking to do here is buy as price breaks away from the double bottom. So once again, our entry options are either that we can look to take an aggressive entry, entering on reversal candlesticks at the level, or we can look to wait for price to break above that reaction high and get long there with our stop below the low of the pattern. And then as ever, we're simply looking to target a minimum of a 2 to 3 to 1 return. Okay, so we covered quite a few things in that session, and I hope that you found that really useful and interesting. As I say, price action is at the core of my own trading, and these are the few of the core patterns that I've focused on over the years to help me highlight trades. And someone's just asked, is this the D1? Yes, this is a daily chart. Now the great thing is about these patterns is that you can typically use these on any time frame. Okay, so you'll find a lot of traders using these for quick intraday trades, and then you'll find longer term traders using them on the daily and weekly charts. And really, as with any setups, the same principle applies. You'll simply find that on the daily and weekly charts, so the higher time frames, the trades tend to have more weight, whereas on the lower time frames there is a lot more noise, and so the trades can be negated a bit quicker. But there are a lot of traders who trade these on the 15-minute and 1-hour time frames, specifically flag setups, looking to use breakouts and then consolidation and another breakout. So depending on what time frame you trade, simply have a play around with these patterns, do a little bit of back testing, see which patterns work best on which time frames, and then you can simply take it from there. So before I wrap this up then, are there any more questions that I can answer for anyone? No? Okay, great. Well, look, I'm really pleased that you've all enjoyed that session and found it useful, and I look forward to catching up with you all in the next session. So this recording will be available to everyone, so don't worry if you've missed any of this, you'll be able to access the recording. That will be sent out. Okay, best of luck with your trading, everyone. Take care, and I'll catch you soon.